Hi folks, Navi Dowty here in the Chicago area in the Midwest in the great United States. This week, let's talk about how to avoid capital gains taxes. This still seems to mystify the public. When people are contemplating selling an asset like a house, an investment property, stock, or a business asset, it's usually to make a profit or to raise cash. Sometimes a house is sold in order to buy a bigger or smaller one, to move to a different town, to take a new job, or in the case of stocks, it might be for the taking of profits, stopping further losses, or again, to raise cash. One common thread among all these decisions is that people generally think about them for some time before they act, as usually these are among the largest assets that they have. What we see often in the tax planning world is that people sell the asset, and then after they have cash in hand, they call their advisor or accountant and ask, is there any way I can avoid paying tax on the sale that I've already made? At that point, the response is often, the sale's happened? No, we can't help you. You're going to pay some extra taxes. The fact is that there are many tools that can be utilized to reduce, delay, or in some cases completely eliminate taxes on all these kinds of sales, but the vast majority of the tools that tax planners can use to help depend on a timeline. For example, before you sign an agreement with a real estate agent and list your house for sale, you have all the planning options that the tax code allows available. After you sign the contract, you use an entire category of planning techniques. So 8 planning options might be reduced to only 4 with that signature. Then at the closing of the sale of the property, if a qualified intermediary is not used to hold the funds, you may lose the ability to do Section 1031 exchanges in various forms. The list of planning options gets smaller and smaller until by the time the client calls the accountant and says, can you help? The question becomes, how long ago did you sell it? If the answer is 5 months ago, then there is still one planning option left. If the answer is 7 months ago, the answer is unfortunately no, there are now no planning options left. So the moral of the story is, if you're thinking about selling an asset, before you take any action, sit down with a tax planner first. The longer you give them, the better. If it's 2 years and a day, you have a whole panoply of options available. This will allow you to consider all the options available for mitigating some or all of the tax consequences of the sale. Every step you take in a sale process without planning first takes away more options. I'm Navi Dowty, and remember, financial fitness can be beneficial to your wealth.